Hey, it's Jim, and this is level 1 of the CFA program, the topic on financial statement analysis, and the learning module on an introduction to financial statement analysis. This is the first of 12 learning modules. And recall that over time, the Institute really is increasing both the breadth and the depth of this FSA topic. And after all, you're going to be faced with about, 13 or 15 or 17% of the exam is going to come from these 12 learning modules. Let me say a couple of things before we get to the learning outcome statements. First of all, and I tell my students this all the time, when you look at a set of financial statements, they need to have 3 characteristics. They need to be accurate, they need to be transparent, and this is probably the most important characteristic inside of this learning module is that they need to be useful. And we'll see that as we go through this slide deck and then the next 11 ones. The second thing I wanted to say is that I'm sure you noticed that the Institute has now provided with some preliminary or prerequisite readings, which I'm hoping that most of you read, but I'd be surprised if many of you did. You think about what back in the old days, of course, over 2 decades ago when I went through the program, there was a reading, they called them readings back then, on, the balance sheet, the income statement, the statement of changes in cash flows. So they're put into these prerequisite readings. So my question to you is, hey, do you need to go back and read those? And I'm going to ask you one simple question. Do you suffer from overconfidence bias? Now, we're going to spend lots of time in level 2 and even level 3, especially level 3, about behavioral issues in finance, and overconfidence bias is one of them. So this is what I would like for you to do. I don't ask for much. I ask you to pay attention, but I don't ask for much. Pause the video right now and go back and do yourself a quick favor. Just skim those prerequisite readings, just to remind yourself that, back in my undergraduate days, or maybe if I have a master's degree, I recall the balance sheet. So you know about the assets and the liabilities and the equity and the fundamental law, the fundamental equation of accounting. And then the income statement, the income statement is really just kind of a mini statement that you could throw it in the equity portion of the balance sheet. And then the statement of changes in cash flows. Just spend, 5 or 10 minutes going back to convince yourself that you don't suffer from overconfidence bias. Even though I think the Institute has either said or implied that there won't be any explicit questions from those prerequisite readings. But you need to know what the income statement is to be able to answer a question about how to analyze a financial statement. Yeah, these LOSs are pretty straightforward. Notice the action word is describe in each of these. And when you go to the 15 or 16 questions at the end of this learning module, you'll see that many of them are super simple. They're almost definitional in nature. So we need to pay attention to the terminology and the responsibilities of the groups that are involved in not only putting together the financial statement, but also those groups who are responsible for making sure that those financial statements are, what did I say earlier? Accurate, transparent, and useful. Think of Enron over 2 decades ago. Enron, they had beautiful financial statements if you looked at their annual report. Boy, they were all in a line, right? And they all added up on the balance sheet. But they were not terribly accurate. They were not terribly transparent. And of course, they were entirely non-useful, unuseful, lack of use, whatever that word is. So, all right, so let's go ahead and start with some of these steps. So what's a definition of financial analysis? I'm going to give you a key to answering some of the questions at the end of this learning module, and probably for your level 1 exam. Look at what we have bolded there. That word evaluating is super important. So there are lots and lots of steps, but the evaluation stage, the assessment stage, the interpretation stage is probably the most important component of that. And so look at the bullet point there, used to make investment decisions and recommendations. And so what's the goal? Essentially, the goal is to identify overvalued, great day in the morning. Excuse me. What was I saying? Overvalued and undervalued securities. And the starting point is to go ahead and look at the financial statements. Now, what we're going to do, not in this learning module, but in future learning modules, is to do things like compute ratios. And then not only are we going to compute current ratios, but there are two components to this. And I test my students on this all the time. You have to look at the pattern of those financial ratios over a 3 or 5 year period. And then you need to look at a comparison against the competition. Two parts to making investment decisions and recommendations. Now, the framework is that we're going to use these financial statements. We're going to use any supplemental information that we can get our hands on, and then other sources as well. When I wrote my dissertation 100 years ago, I used the LexisNexis database, and that's where I found tons and tons of information on poison pill companies. So whatever's out there, you need to learn how to find it, and you need to learn how to use it. Now, a couple of good questions at the end of this learning module on the framework here. So we'll go through phase 1 through 6 here over the next handful of slides. All right, so phase 1, articulate the purpose. Yeah, what are we trying to do? Well, I said this earlier, kind of a general idea. We want to identify under and overvalued securities. Well, think of that as the umbrella. And how do we make that final conclusion? Well, maybe what we want to do is look at some portion on the left-hand side of the balance sheet, or the right-hand side of the income statement, or the operating cash flows on the cash flow statement. So we need to identify what that purpose is. And there's lots of different ways to do this. There's a good example there. Periodic credit review of investment grade debt portfolio. Boy, that sounds like a mouthful there. But of course, we're going to learn tons and tons of stuff throughout the CFA program about investment grade bonds, about junk bonds or speculative grade bonds. Now, look down at the bottom, substantial amount of data. That makes perfect sense. Now, one of the cool things that the Institute can do, and it has done in the past, and if I were making up these exam questions, I would throw this in there. Look at that, what is that, the third embedded bullet point there. Other complex analytical tasks. Notice there's a couple of words in there, tools, relative importance. So remember all the stuff that we were learning at level 1 in quantitative analysis. So think about a question where you could be given, let's just pick something, maybe a regression analysis framework, and you're trying to look at the relationship between, let me just pick 2 variables, maybe dividend yields and cash flow, or dividend yields and stock returns, or dividend yields and the performance of the bond portfolio. Or, you can come up with tons and tons of these kinds of things. So look for a link with other areas inside of the program to be able to identify the purpose. Hey, what we're going to do is we're going to do all this stuff, whatever that stuff is, in the hopes that we can find something useful in these financial statements. And then, here, do I need to go back here? What does this say right here at the bottom? Draw conclusions and make informed recommendations. The next step in this articulation here has to identify what that intended audience is going to look like. Who are we doing this for? Maybe we're doing it for ourselves. Maybe we're doing it for our client. Maybe we're doing it for the firm. Maybe we're going on television and we're going to make a big report in front of a business audience. And so we need to figure out what the timeline is. That's super important. I have my students in my investments class, they have to do this semester-long project. And so I tell them, hey, you know what? If you don't do it at this time period, it's not going to work at the end. List the resources, list the constraints. That's probably important. Notice down at the bottom, we've got what are these sources of data. I mentioned this just a few moments ago. And then what is the output going to be? Collection of data. I'm not quite sure how the Institute can ask you a really, really good question on here, but some of these things are obvious notions. We're probably going to try to answer a complex question. So I think the interesting question on the exam would be, what is the source of that data, how can we collect it? How can we put it in a spreadsheet or some other kind of software so that we can get the most out of it? Yeah, company websites, investor relations, this is what I was saying earlier. One thing that I have my students do in the investments class is they perform a macroeconomic analysis and an industry analysis, and there's tons and tons of stuff. Mostly my students go to one of the Fed web pages, and they'll get tons and tons of stuff out of that. How about the processing of data? There we go. Calculated ratios, common size financial statements, which is what you should have learned back in those prerequisite readings. Creating charts, statistical analyses. We'll go ahead and we'll talk about regression analysis. In level 2, we'll have great conversations on time series. And then level 1, level 2, level 3, we'll have to know everything about Monte Carlo simulation. This is one of my most favorite things out there, because what the Monte Carlo software does, or the simulation does, is it will take some input variables, and each of those input variables will have its own distribution. And so essentially what Monte Carlo does is reach into that bucket for that particular input variable and pull something out of a distribution. It doesn't have to be a normal distribution. It could be Jim's distribution, whatever that thing is. And then put that into the model and then run an output. And so there's the output. Maybe it's net present value, maybe it's stock price in 6 months, whatever it is. And so Monte Carlo then reaches into all these different buckets. If you have 5 input variables, it can reach into those either individually or simultaneously. And so you get all of these outputs, 10,000, 100,000, a million, a billion. I don't really know how many you can do. Of course, we'll learn about Monte Carlo in the future. It's really a marginal cost, marginal benefit analysis. This computing stuff takes tons and tons of resources. But what we'll do with regressions and Monte Carlo and other things out there is that we'll make forecasts, we'll perform valuations, and we'll conduct a sensitivity analysis. And of course, Monte Carlo can perform sensitivity analysis. Yeah, so what are we doing with processing the data to finish this up here? Understanding the factors. Oh my gosh, we're going to talk about factor models throughout level 2 and level 3. That'll be super important. For example, does a growth firm, does the firm that has a specific price to book value, does that have any influence in terms of being able to make some kind of a conclusion? I mean, the answer to that question is probably going to be yes. I like the third bullet point down there. Make necessary adjustments to financial statements. We'll do this in future learning modules where we say something like, oh, this particular firm has presented this data in the following manner, but we're comparing it against another firm over here who does a little bit different. And so in order to compute the ratios and compare them reasonably, we need to make some kind of adjustments. If you go back to your undergraduate accounting days, that big adjustment. And by the way, I couldn't stand this. In 1981, whenever that was, when I was sitting in my first accounting class, switching over from LIFO to FIFO. Oh my gosh, I remember thinking, gosh, why are we doing all this? But I was an immature 20-year-old back then. Now I understand these are necessary adjustments. Now, phase 1, phase 2, phase 3. I can't imagine the Institute is going to ask you hundreds of questions, 15 or 17%. There's no way they're going to do that, at least in my estimation. You need to be prepared for, maybe one question in each of those, or maybe one out of those first 3 phases. This is where this phase 4, where I think are the important questions here. Interpret the output. In fact, these questions at the end of this learning module, the correct answers all have the words either evaluate or interpret or assess in there. Remember those key words. Yeah, communications and conclusions. Look down at the bottom. That's standard 5 members and candidates. Now we do this back in the the code and the professional standards. We must clearly communicate key factors, et cetera, right? So develop these communication skills. So it's one thing to be able to go through phase 1 through 4, and in the back of our brains, we could say something like, hey, you know what? I understand all this, but we need to communicate this with whoever the target audience might be. And that target audience might be someone who's sophisticated. It might be a group that's terribly sophisticated, or it might be a group that has no idea. They've never even heard of a balance sheet. So we need to pick out that appropriate format. We need to put together the guidelines and the objectives. And we need to consult those regulatory agencies and the professional standards, not just the Institute's professional standards, but any other professional standards that we're obligated to adhere to. Yeah, sources of data, we've talked about that a little bit. So what's the output? So the output is going to be some kind of analytical report that addresses the purpose back in phase 1. And so here's a great exam question. So you have a question stem in which the first sentence says, the purpose is to identify high dividend yielding firms, or something like this. And then the question somewhere will say, and the analyst makes the recommendation that, firms that have lots of leverage have lots of dividend yields, or something silly like that. Well, clearly there's not a relationship between the recommendation and the purpose. I think that's the good question here. And then what we'll learn, if you haven't heard me say this before, you'll hear me say it 100 times by the end of level 3, is that the Institute, they're very, very big, and this is a critical component. This phase 6 is, all right, we've done all this work. That's not the end of the story. In fact, it might be just the beginning. I don't want to say the beginning, but the middle, at least the middle of the story, because we have to decide, hey, we did all that work. How did we do? Did we do a good job here on the balance sheet or the income statement or the cash flow statement? Where did we make mistakes? Where can we improve, et cetera, et cetera. And so look down at the bottom. There are words like revisions and comparison and being updated. So look for the question of the follow-up with those 3 words in it. All right, how about the role of financial statement analysis? You probably know this already, right? So why are we doing this? Well, we're doing this because everybody who invests in either fixed income securities or equity securities or alternative investments is not an expert. What that means then is that there's tons and tons of organizations and tons of individuals and groups of individuals out there who need financial statement analysis reporting. And so it's our responsibility as good wealth managers and good financial analysts to figure out what the financial condition is of a particular firm or a particular entity. Yeah, essential for informed investment, credit, and other economic decisions. Gosh, it'd be awesome if the Institute asked you that question right there. You'd jump all over that correct answer. Now look down at the bottom there. Do not solely rely on financial statements due to access to non-public financial. All right, so what are we doing here? We're going to have a particular economic decision in mind. So what did I say? That umbrella was the identify overvalued and undervalued securities. So assessing equity investments for portfolio inclusion. What that means then is that not only do we have to look at the individual companies and its financial statements, but we can use regression analysis. We can use metrics like the Sharpe ratio. We can use other kinds of things to be able to assess that, not least of which is some of the material that we learned in and will learn in level 2 and level 3 in quantitative analysis. Things like standard deviation, things like beta, things like correlation coefficient, things like how those impact the diversification. Creditworthiness for loan decisions. So this thing here is the top right of the balance sheet, where we're going to say, okay, let's suppose we issue a bond out there or we take out a loan. How does that impact the financial leverage of a company? On the other hand, suppose we're on the left-hand side of the balance sheet and we're a financial institution and we want to make a loan to a business. Well, that loan shows up on our asset side of the balance sheet. So that creditworthiness, that applies to both right and left-hand side of the balance sheet. Oh boy, there's venture capital. We're going to have lots and lots of good conversations about alternative investments and private equity and private debt and venture capital. So those will be really fun conversations. And what they are is they're essentially different in that information is not as publicly available as it is for publicly held companies. And then one of my favorite topics is potential mergers or acquisitions. You got two firms, both of whom could be public, both of whom could be private, or one could be one of each. And so those present some extra challenges here. But what are we going to do? We're going to use the information and the data that's available to us to identify undervalued or overvalued firms. Of course, we don't want to take over another company if it's already overvalued, and then we'd have to pay a premium for that. Of course, that's a total waste of time. Here's a couple of slides about T-Mobile and its 2022 performance. I'm not going to go through all of these details. I'll make some concluding comments here in just a second. A couple of things that I want to note is that reminding ourselves what we learned back in that prerequisite reading on the income statement, total revenues. This is important. So what did I say earlier? Total revenues, what do? We go 20, 19, 20. All right, so what does that mean? We can put a path together for all these quarters and look at the pattern. That's important. But then we need to go and look at the competition. What if Verizon has 20,000? What if Verizon has 80,000 and AT&T has 150,000? Well, that tells us that we have just a small slice of the pie. Second thing I wanted to mention is this, the third row there, cash provided by operating activities. So this is important in terms of evaluating the quality of the assets. We're going to have really good conversations on these two guys named Modigliani and Miller, and they're going to teach us a lot about both the right and left-hand side of the balance sheet. But essentially, the goal of the business, which we know from earlier, is to maximize shareholder wealth. Well, that sounds really good. What does it mean? The application of that goal is that what firms try to do is they try to find projects that generate lots and lots of sustainable cash flows. Not just cash flows today, but cash flows that can be sustained over an extended time period. And most of those firms, of course, probably have branded product lines. So think about the importance of that net cash provided by operating activities. And by the way, that's reflective of the business risk of that particular company. But then I want you to skip a row and look at these cash purchases. So what this means is this is the line on the financial statements which tell us how much this particular firm is investing in what it expects to be positive net present value projects. So, of course, if T-Mobile, what is that number, 3383 in one particular quarter, what can we expect? So that's a cash outflow today, but what do we expect to get in the future? Well, we expect to get that back plus a lot more over an extended time period. So what we've done for you here in this slide, and I'm not going to go ahead and waste your time. You can pause the video and read these and go back and say, oh yeah, there we go. Company earned 118, et cetera, et cetera. And so these are the kinds of conclusions that are reasonable based on a study of these financial statements. All right, let's switch over to government bodies and regulatory bodies and legal authorities. Now, wouldn't it be awesome if, of course, all of the operations inside of the financial services industry was just self-regulated? If we all trusted each other and said, you know what, we're all nice people, we're all pretty ethical, we're pretty reliable, we're pretty accountable, we don't really need anybody else coming along and telling us what to do. But of course that's not true. So we need the government, so we need regulatory authorities who have a legal authority and can punish. Go back and think of Enron and think of Martha Stewart if you'd like to, and tons of other people out there. So what this means is that, hey, we need to have somebody out there who's enforcing, what did I say earlier? Accurate. What does this mean, accurate? So we need to go out and count the number of items that are in inventory so that that's accurate. It needs to be transparent. That if we're a farmer and we say, you know what, we have 100 apples in, Honeycrisp apples in our inventory, but don't worry about the simple fact that 12 of them have worms and we're never going to be able to sell those things, right? So that's not, it's accurate, right? There's 100 Honeycrisp apples, but it's not transparent because of the worm factor. Is that one of the factors that I referred to just a little bit ago? I don't think Fama and French had the worm factor in their model. And then what did I say? Useful. I mean, you think about it. If you're reading 100, is that really going to be useful? Because you're going to compute some kind of an inventory turnover ratio based on 100 rather than, what did I say, 12 worms, so that rather than 88. Yeah, so we need somebody out there who's going to come in and say, you know what, these are the rules. Please follow the rules. And here are a couple of examples. This International Organization of Securities Commissions, established a long time ago. I was in college in that time. Probably many of you weren't even born during that time. Oversees a significant portion of the world's financial capital markets. Now, I thought this was interesting here. The Institute tells you about the ordinary members. And so these ordinary members are people like in the United States, the SEC, Securities and Exchange Commission. So the ordinary members are those commissions that are created by federal governments. But the Institute doesn't tell you about associate members. These are tend to be supranational organizations. The affiliate membership is usually like individual stock exchanges or some other kind of an exchange. Some of the statistics you can read in those bullet points. Since the Institute doesn't mention associate or affiliate, they just say ordinary or just regular securities commissions by federal governments. This is probably not a really good exam question. What is a good question is, what is the purpose of these regulatory authorities? So, comprehensive set of objectives and principles of securities regulations. Think of this as the equivalent of the Institute's Code of Ethics and the professional standards. Here's the exam question. If I were making up, I would say protecting investors, fair, efficient, and transparent markets, and reducing systemic risk. 10 groups. I can't imagine the Institute would say, what's the difference between self-regulation and auditing? You probably figure that out based on whatever's given you in the question stem. But I do think that the required in that second diamond point there, full disclosure, accurate disclosure, timely disclosure. So this is kind of easy to assess if you take a company like Johnson & Johnson, and you can look and you can find that they have published and released financial statements for the last, 1,000 years for Johnson & Johnson. But if we have Jim's Concrete Company, maybe I put out a financial statement whenever I feel like it, every couple months, maybe every couple years, or maybe every 5 years, right? So we need to have a conversation, and this will be something that we talk about in a future learning module about the quality of the earnings. So we'll defer that to another day. Yeah, look down at the bottom here. Yeah, attaining this goal of uniform regulation. So you know there are going to be economic differences and political differences and cultural differences and probably some other differences out there between and among different societies and different regions of the world and different countries and different sets of rules. But what this international organization is trying to do is to try to promote this uniform regulation. Now, this is what I was saying earlier. These self-regulatory organizations, of course, the Institute is a self-regulatory organization because it has a set of rules. And in order to use the designation, you have to abide by this set of rules. And every year you have to sign a little piece of paper that says, "Hi, Jim, I haven't done any of this stuff over the last year." So what are some good questions there? Well, we've highlighted some good words: fairness and confidentiality, cross-border cooperation. Here's a couple of interesting things about the SEC here in the United States. Look at that first teardrop point. Yes, it's an ordinary member. I said that earlier. Established after the 1929 stock market crash, and it regulates all sorts of stuff. A couple of laws that were passed after the financial crisis, after the financial crash in 1929. And by the way, I wonder if you guys have a good history lesson on the Depression. The Depression was not caused by the stock market crash in 1929. It was caused by lots of stuff that the federal government did in the several years of the aftermath. But some good things came out of it, and one of them is the Securities Act of 1933. And so this tells us that, you know what, it's not anarchy out there on financial exchanges. What we're going to do is we're going to rein in all of this unethical behavior, right? Yeah, so the Exchange Act of 1934. And by the way, I don't think it's a very good question, but I would make sure you know the difference between the two, Securities Act of 1933 and the Securities Exchange Act of 1934. And then I'm guessing you guys, gosh, maybe some of you weren't even born in 2002. This got its start because of Enron, right? In whatever year Enron was, 1999 or 2000. And then we had the dot-com bubble. So this Sarbanes-Oxley established this public company accounting oversight board to oversee all of the public accounting firms and their mandated auditor independence. You guys know the Enron story. Enron had an auditor, and it was paying this auditor some crazy amount, weekly or monthly, to go ahead and give advice on their derivative securities transactions. So there was a tremendous conflict of interest there. So there was a lack of auditor independence, and so we needed that here. So look at that third teardrop point as well: enhanced corporate responsibility for financial reports. If you read the Wall Street Journal regularly, you'll see every once in a while nowadays, it's not as common as it was, 15 or 20 years ago. You'll see that some company, and maybe its board members, maybe its executive leadership team, is being sued because they provided financial statements that were perhaps misleading. Yeah, let's go back to this security offerings, the registration statement. Not really any great exam questions other than definitional in here, but what we need to know is that when a company decides to issue a bond or shares of stock, it needs to tell everybody about it. It needs to tell the SEC about it. And so look at that required information. There's got to be disclosures. There's got to be recently audited financial statements. There needs to be some comments about the risk factors. There's probably not the worm risk factor that I talked about a few minutes ago. How do these companies comply? Well, I urge you don't need to do this right now, but just go ahead and type in, annual report for a particular company like Johnson & Johnson, and you'll get all sorts of fun stuff in there. And so the SEC, since it's a government body, it publishes all of this stuff easily accessible online. Over 50 different SEC forms. Gosh, don't even worry about all 50 of those things. Yeah, so what do we have to put in this annual report? So we've got the 10K, the 20F, the 40F, types of business, risk factors, audited financial statements, management information, legal proceedings, all sorts of really fun stuff that's in there. For the annual report, type of business. And by the way, back in the old days when I was going through graduate school, you had to get an actual physical copy of the annual report. And Barron's, we used to subscribe to Barron's, and Barron's would send you free annual reports from all of these companies. So I used to make my students, you have to write a letter to Barron's. Dear Barron's, can you send us you guys know how to write letters? You have a letter, you address it, and there's a stamp. You have to put the return address. Nowadays, you just click a button and it's right there. So I'm not sure that this is progress, but lots of people think it is. I would love it if you took a sledgehammer to my cell phone so I never had to look at that thing ever again. So anyway, progress tells us that, boy, you can have access to this thing fairly quickly. Yeah, I'm guessing that this exam question, look down at the bottom there in blue, the Form 10K is more legal in nature. Proxy statements, when I wrote my dissertation, I read at least 1 million different proxy statements. Of course, I'm exaggerating there. But every year, the shareholders are invited to the annual meeting, and they do this through a proxy statement. And so the proxy statement reads something like this: Dear Mr. or Mrs. Shareholder, you are cordially invited to attend our annual meeting. Here, our headquarters are in this particular city. We're going to have the meeting on this particular date. We'll do it at this particular hotel or wherever it is. And by the way, this is the stuff we're going to do during that annual meeting. And so the primary one is to elect a board of directors. So you'll see a biography and beautiful touched up pictures of every individual who the executive leadership team is supporting for board membership. So there's all different sorts of extra things that can go along. That's the important one. Some kind of shareholder proposals, whether it's a classified board, whether it's a merger and acquisition, and then executive compensation disclosures. These are all fun things. And remember, let me give you just a little bit of an editorialization here. When you read the Wall Street Journal in the early part of the year, it always has a feature article on CEO compensation. And so we'll read about the CEO made $40 million last year, $50 million last year, whatever it is. But if you look at it, their salaries usually are $4 million or $6 million or $8 million. But then they have this huge compensation for bonuses and executive stock options and all sorts of other fun stuff. We'll detail those in some other conversation. Yeah, this Form 8K, these are material corporate events, acquisitions, change in securities. One of the things I learned back writing my dissertation is that a poison pill security, this was ruled on by the Supreme Court of Delaware, does not have to go in the Form 8K. It's just part of regular old business operations. And so the executives, they can adopt a poison pill just like that. They don't even have to tell anybody, but of course they do through all this release in the SEC. Yeah, beneficial ownership. So this is what I was saying earlier. I didn't use that term. So if an executive has exercised those options, that shows up in compensation. But if the executive has not exercised those options, if they are granted but not exercised but still vested, well, then that's a form of beneficial ownership. So look at the forms. There's a 3, a 4, a 5, a 144. Oh boy. I'm just going to scratch my head. You guys figure out if you want to memorize all of those. And finally, in regards to the SEC, notice that third bullet point down there, establish reporting and filing requirements. And we're looking for international cooperation here. So the SEC, they just enforce stuff just like the international group does. Now, how about over in Europe? Look at that first orange bullet point there, that the EU listed companies adopt the international financial reporting standards. So this is a great source of questions and concern for all of us in this industry. Couple of things here, 2 bodies to regulate securities, the ESC and the ESMA. I'm guessing this could be one potential exam question regarding the difference between the two. Remember, the authority is the cross-border supervisor. That would probably help you answer that question. Responsibility for securities regulation, just like the SEC. But here's where it gets just a little bit more interesting, and I think there are better exam questions in here about the financial statement notes and some supplements there. So these notes, they're required to be listed and presented right along with the financial statements. Of course, all the disclosures will show up in this, will show up in the notes or the supplements. And I learned this back when I was an undergraduate, way back a long time ago as an accounting major, is that without the notes and any supplements, you really can't completely understand the financial statements, right? You can't make an assessment of, what did I say earlier, accurate and transparent and useful. All right, so what are some details in the notes? Yeah, calendar year, fiscal year, accounting standard used, currency, consolidation of financial statements. How about that middle column there, the accounting policies? Yeah, so IFRS and US GAAP, they have some differences in there, and we're going to have to reconcile those differences, not just in level 1, but all the way through level 3. Some additional disclosures. Segment reporting, which we're going to talk about here in just a little bit. The Institute has a nice section on the requirements for segment reporting, acquisitions, on and off balance sheet debt. Go back to my Enron example. They had tons and tons of off balance sheet financing. They weren't the first, but they were among the first to abuse the special purpose vehicles. Legal proceedings and some other things here. Here's an example of T-Mobile. Here are notes, 1 all the way down to, I don't know, could be 500 really if you really wanted to get too technical. And there are the page numbers that you can see in that report. If you click on note 1, you get this paragraph here. Consolidated subsidies, variable interest entities, intercompany transactions. There's a segment, there's US GAAP, there's estimates and assumptions. Notice what we did is we bolded some of those key words that might be a signal to you in the question stem that says something like, hey, which of the following ought to go in the notes? And if you read something about estimates or assumptions or subject to judgment, that goes into the notes. So here's a couple of slides on this segment reporting. They do not, in U.S. and in international group, they do not mandate disaggregated full financial statements for all subsidiaries. I mean, after all, how many companies out there just have one product line? You got a bunch of product lines for every company out there. But what these governing bodies like us to do, what they require firms to do, and the accountants to do, is to give us some information by operating segment. And so let's go ahead and define that operating segment. You can define it really however you want to. Maybe it's on something that's on the top right-hand side of the income statement, revenue generating, or maybe the left-hand side of the income statement, expense incurring activities. These results are, of course, regularly reviewed. Here's where it gets just a little bit technical. I don't imagine the Institute would give you an 8% or a 10% or a 12% question, but 10% or more of combined operating segments. So there we go, revenues or assets or profits. So those are probably the 3 categories to look for. And then there's another percent there, 75% of total company revenue. So small segments, they can be aggregated. And remember, it's not like US GAAP people are going to say, hey, if I'm Jim's Concrete Company and I have 4 segments, and I have one segment that only accounts for, let's say, 4% of profit, they're not going to come and throw a yellow flag on the football field if I report that 4%, right? Transparency, more kind of information. But what they do like to see is, some of these things that are material or substantial, and that is a requirement. Now, what about the disclosures here? So we can disclose revenue, we can disclose profits, we can disclose balance sheet stuff. We can disclose investments in PPE. That's, remember, investments in positive net present value projects, depreciation. And then we can do some kind of reconciliation. We can have, if we do, what did I just say? 4 segments for Jim's Concrete Company. We can reconcile all those based on each segment. So then when we look at the total statements for Jim's Concrete Company, they sum to the same number. Now, we mentioned just briefly this MD&A, and this is where I would love to write some of these things with some flair rather than some just general boring and dull business kind of conversation here. But this management's discussion and analysis really gives you kind of an estimate of and a basis for some of the decisions that may show up in the notes, but you can see them in the financial statements. So look at that second embedded bullet point. Variety of issues, nature of the business, past results, and the outlook. Management commentary on just about anything there. I would love to throw a James Bond reference in one of these things, but of course no one's paying me to do that, so I'm probably not going to. Now let's go ahead and continue this kind of conversation about the difference between what goes on internationally and what goes on inside of the United States. So let's do the International Accounting Standard Board's guidance. So these are 5 content elements. I would know those 5 content elements: nature, objectives, resources, risks, results of the operations, and then critical performance measures. So the international group, they have these 5 elements. Now, of course, over in the United States, in the SEC, those 5 elements are probably going to be contained in those content specifications. So trends, significant events, liquidity, inflation, off-balance sheet, and critical accounting policies. It's just that here in the United States with GAAP, they can show up in, maybe different kinds of sections inside of this report. But in the international group, you got to do those 1, 2, 3, 4, 5. Now, remember I was telling you about Enron and its auditors as kind of having this tremendous conflict of interest. And so look what we have: audited by an independent accounting firm. So Enron, they failed that test a long, long time ago. So what we're trying to do is say, hey, here I am, Jim's Concrete Company, and over there is Betty's accounting firm. And so I don't really need to have a relationship. In fact, I shouldn't have a relationship with Betty and her accounting firm over there. With the exception of course, I invite her over, I show her all of my offices, all of my operations, and I say, here are the financial statements that the internal accounting people put together. You guys figure it out whether or not it's something that is reasonably acceptable. And so what Betty is going to do is put together some kind of an accounting report. And so there are standards of auditing. If I'm Jim's Concrete Company and I have 4 concrete trucks, then Betty's going to come in and say, hey, 1, 2, 3, 4. Okay, you have 4. So there are standards for doing this. Gosh, I would have no idea what the auditing standards are for concrete because, what goes into concrete? You have to have water, you have to have sand, you have to have rocks, you got to have whatever else goes in there. And by the way, a long time ago, I was a big construction worker. Pouring concrete on a bridge. I think I'd know more about it than I actually do. Country-specific standards, of course. So there are 2 main objectives: reasonable assurance, and then international standards for auditing. So what we're doing is we're going back to what we said in one of those very first slides about what is the target audience out there. Well, the target audience for this auditor's report is anybody who's really interested in that particular company. So you can have one of these 4 opinions. We're looking for that top left under the green A, an unqualified opinion. This sounds something like Betty would come in and say, hey, you know what? This is Jim's operation. Here are his financial statements. And we're going to offer an unqualified opinion because it looks pretty good to us. But then you can have a qualified opinion in which Betty would come in and say, you know what? The majority of Jim's financial statements and his operations are reflected. What did I say? Accurate and transparent. But boy, Jim did something over here with the rocks. With his rocks, he counted these things over there in that way, but we're not quite sure that was the right way to count the rocks. And then an adverse opinion, Betty might come in and say, you know what, Jim has some rocks over there, but I have no idea how he's counting those rocks. And then the disclaimer, they would say, I don't think Jim has any rocks over there. I don't know. Does the rock example with Jim's concrete company? Boy, maybe that'll pop up during the exam, and you'll be able to answer that question correctly. All right, so here's an example. What do we have in underline there? In our opinion, the consolidated financial statements present fairly, etc., 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 etc. Now here's where it gets interesting, and I think the Institute has a history of asking these good questions. The goal, of course, is for IFRS and US GAAP to converge, right? So that's the goal. However, whenever you get two groups of people together, they're not going to agree on every single thing. Just watch an NBA playoff game when they go to the replay, right? And I can't stand the replay. Instant replay has ruined all sports, by the way. But there are 3 refs in an NBA game, and so they go to the replay, and 2 of them go over there. And if the 2 of them agree, then that's the goods. Then they agree on the outcome. But if they disagree, then they bring the third person in, and that third person gets to break the tie. So of course, there's going to be differences. So look at that diamond point there. What is that? Blue or green? I can't see that. Differences between IFRS and US GAAP are critical. So this is probably going to be the source of these good questions. Now, a lot of times I'll have students, and maybe I've done this already or this early in level 1, is get out your phone and take a picture of a particular slide, keep it in a file so that you can, when you're on the train or on the plane or you have 5 minutes to kill, you get out your phone and you can scroll through some of these things to prompt your memory. So what's the coordination here? We aim to reduce this difference. So this is this idea of convergence. So what are we doing? We're trying to converge. And notice in bold there, that second bullet point in the middle column. So whenever there's a new accounting standard out, these mostly converge. And that's probably a cool thing. And then this is where, on this far right column, this is where we come in. Where the standards have not converged, we need to go ahead and be aware of those areas and then converge them ourselves. Is that a term? I'm not sure that's a really good term, but converging ourselves or make them compatible so that we can make a comparison. Take a picture of this here as well. So IFRS, this is a principle-based idea. GAAP is a rules-based. So we'll talk about the difference between principles-based and rules-based throughout the program. Look at that third one there. This is what I was saying earlier. The international people, they allow FIFO, US GAAP, LIFO, and FIFO, and weighted average, and maybe even Jim's inventory method, although probably not. But so this is a great exam question. Okay, you got a firm that does LIFO here in the US. You're comparing it to a European firm that does FIFO, and you have 2 completely different method evaluations of inventory. How do you reconcile those? And there's a couple other ones there that you should probably be aware of. All right, how about monitoring developments? Yes, so what are these monitoring developments? Of course, there's all sorts of new stuff that's coming along. Who would have guessed that in the year 2000, when the internet was in its infant stages, that we would have a point now, some 2.5 decades later, where we have all these businesses out there that didn't even exist back then. So ongoing developments. How do you handle what goes on YouTube? You guys watch a lot of YouTube videos, I bet. These ads pop up. So how do you recognize that revenue? When do you recognize that revenue? How do you deal with it at expense, especially if there's an in-kind transaction in which there's really no cash trading hands, but someone says, hey, if you put my ad on your YouTube channel, I'll put your ad on my YouTube channel. So the in-kinds, how do you deal with all this stuff? So these are ongoing developments. And so it's important to remember that we have to assess these for identifying over and undervalued securities. That second bullet point there, this is an obvious one. So the analysts, what we're doing, right, we're trying to figure stuff out so that we can help all the investors throughout the world. But the public accountants, they're essentially trying to figure out what the firm is doing, what the executive leadership is doing, and what that preparer's perspective. So those are two different perspectives. Yeah, look at the bottom. Staying informed. That makes perfect sense. And there's the example of what we're trying to do here. Monitoring new products and transactions. What are some examples of this? Fintech and cryptocurrency. I've done lots of research on Bitcoin and all that stuff. And it's fascinating. But I still, maybe there's about this much to know. I still only know about this much. I don't suffer from the overconfidence bias that we talked about at the beginning of this. Yeah, crucial to understand the business purpose. So economic purpose, financial statement, cash flow, that makes perfect sense. Let's move on to a combination of new product development and regulatory action. Let's suppose that I'm some financial institution and I come up with a new product. And this product is a combination of, I'm just going to make this up, are you ready? An interest rate swap, a currency swap, a futures contract, and a derivative based on weather events like an earthquake or a hurricane. Some crazy new derivative security out there. So the question then becomes, how do you value this thing? And then what kind of regulatory action should someone like the SEC develop? Yeah, so this is super difficult, right? So what we need to do is we need to monitor all the changes. We need to make certain as either the SEC or the international group or one of us who holds the designation, we need to be aware of all of these kinds of changes and how they can impact valuation. And I think that if there's a question here inside of this slide, it's probably on the impact. And so my advice is to read the question stem, and somewhere in there, the Institute would have to tell you about the new product. And then the question might be, how does this impact the overvaluation or the undervaluation of your analysis? And you ought to be able to come up with an answer if you say something like, oh, let's take a step back and let's decide, what does this new product do? How can it possibly be valued? Maybe we can use regular old Gordon growth model to value it. Maybe we need to use Black-Scholes-Merton option pricing model. Maybe the interest rate swap valuation model, or a combination of all those. And so establish those kinds of standards, because, let's suppose that this financial institution sells 1 trillion of these things this week. Oh my gosh, isn't that going to totally impact that financial institution's performance, and of course our evaluation of that performance. There's some websites down at the bottom to monitor those changes. What role does the CFA Institute have? Well, of course, the CFA Institute has opinions on stuff. So I'm hoping that you go to the CFA Institute webpage and log in like I do pretty regularly. And I read all these reports, and I read their comment letters and their position papers. And it's really interesting stuff for the most part. I'm not interested in all that. And of course, you're not going to do that as well. But, what do I tell my students? I tell them all the time to read. Read. Well, this is a great source for you guys to read. And then we can volunteer to be members on the liaison committee. I'm not going to do that. Now, what else do analysts use? I'm guessing you guys know this. So earning calls, press releases, Wall Street Journal, social media. I don't know anything about social media, so I don't want to know anything about it. What did I say to you 20 minutes ago? Come to my house and take a sledgehammer to my phone. Proprietary third-party sources. This is going to be very interesting when we talk about third-party risk as we move through the program. And that takes a couple of different forms. But if we're going to go ahead and pay for a third-party report, we need to make sure that it's accurate, right? We need to make sure that that third party doesn't impose any extra risks on what we're trying to do. And then product comparisons and surveys. And that takes us through these learning outcome statements. So this is not a super long learning module, but there's lots and lots of stuff in there. And what this essentially does is set the standard and provide us with a framework to move on to these next 11 learning modules. So what I want you to do now, and boy, I hardly ever do this, but I want you to go to these questions at the end. It's 15 or 16 of them. I bet you can do these in 10 minutes based on what we've had a conversation about during this slide deck. So hey, thanks for watching. Have a great day and good luck studying.